Investing in Lithium ETFs, a comprehensive guide. At the forefront of the clean energy revolution, lithium-ion batteries are powering the growing market for electric vehicles, EVs, and renewable energy storage systems. As the demand for these batteries continues to surge, investors are turning to exchange-traded funds, ETFs, that provide exposure to lithium-related stocks. In this video, we explore the benefits and risks of investing in lithium ETFs, the top-performing ETFs in the space, and key considerations for building a diversified portfolio. Benefits of lithium ETFs. Lithium ETFs offer investors several advantages over investing in individual lithium stocks. First, they provide exposure to a diversified basket of companies involved in lithium mining, production, and battery manufacturing. This diversification helps to reduce the risk of any single company's poor performance impacting the investment. Second, lithium ETFs offer easy access to the growing lithium market, which expects to more than triple in size by 2025. This growth is fueling the increasing adoption of EVs, as well as the growing demand for grid-scale battery storage systems. Third, lithium ETFs provide investors with a passive investment approach that requires minimal research and monitoring. This makes them ideal for those who want to gain exposure to the lithium market without spending significant time analyzing individual companies. Risks of lithium ETFs. Like all investments, lithium ETFs come with risks. One major risk is the volatility of the lithium market, which are factors such as changes in government policies, technological advancements, and competition from alternative battery technologies. Another risk is the concentration of the ETF in certain companies or regions. Some lithium ETFs may have a higher concentration of companies in certain regions, such as China or Australia, which can make the ETF more susceptible to economic and political events in those regions. Finally, lithium ETFs may have higher expense ratios than other ETFs, due to the specialized nature of the sector and the costs associated with managing the portfolio. Top-performing lithium ETFs. There are several lithium ETFs available for investors to choose from, each with its own investment objective and strategy. Here are some of the top-performing lithium ETFs based on their returns over the past year. 1. Global X Lithium and Battery Tech ETF, LIT. This ETF tracks the performance of companies involved in lithium mining, refining, and battery production. It has a global focus, with companies from the US, China, Australia, and other countries represented. The ETF has a one-year return of 91.6% and an expense ratio of 0.75%. 2. Amplify Lithium and Battery Technology ETF, BAT. This ETF seeks to provide exposure to the full lithium cycle, including mining, refining, and battery production. It has a global focus, with companies from the US, Australia, and other countries represented. The ETF has a one-year return of 94.6% and an expense ratio of 0.72%. 3. Global X Autonomous and Electric Vehicles ETF, DRIV. This ETF tracks the performance of companies involved in the production of EVs, including those that use lithium-ion batteries. It has a global focus, with companies from the US, China, Japan, and other countries represented. The ETF has a one-year return of 41.4% and an expense ratio of 0.68%. Considerations for building a diversified portfolio. When building a diversified portfolio of lithium ETFs, investors should consider several factors, including 1. Investment goal. Each ETF has a specific investment aim, which may focus on a specific segment of the lithium market, such as mining or battery production. Investors should consider their investment goals and risk tolerance when selecting an ETF. Geographic exposure. Some lithium ETFs may have a higher concentration of companies in certain regions, such as China or Australia. Investors should consider diversifying their exposure across many regions to reduce the risk of regional economic and political events impacting the ETF. Expense ratio. Investors should also consider the expense ratio of the ETF, as higher expense ratios can eat into investment returns over time. While specialized lithium ETFs may have higher expense ratios, investors should ensure that the expense ratio is reasonable relative to the ETF's performance and investment goal. Risk tolerance. Finally, investors should consider their risk tolerance when building a diversified portfolio of lithium ETFs. Some ETFs may be more volatile than others, depending on their investment strategy and exposure to certain regions or sectors. Conclusion. Lithium ETFs provide investors with exposure to the growing lithium market, which is being driven by the increasing adoption of EVs and renewable energy storage systems. While there are risks associated with investing in lithium ETFs, they offer several advantages over investing in individual lithium stocks, including diversification and passive investment strategies. Investors should consider several factors when selecting lithium ETFs, including the ETF's investment aim, geographic exposure, expense ratio, and risk tolerance. By selecting and diversifying their exposure across many lithium ETFs, investors can gain exposure to this exciting and growing sector while managing their investment risk.